Good afternoon, everybody. Welcome to Adani Transmission Limited Q3 FY20 earnings conference call. Today we have with us Mr. Anil Sardana, CEO of Adani Transmission Limited, and Mr. Kaushal Shah, CFO of Adani Transmission Limited. To start the call, Mr. Sardana will give his opening remarks and then we'll open the floor for question and answers. Over to you, sir.
Thank you, Suresh. Good afternoon, all our analyst friends. Welcome to Q3 FY20 call. You would have got the presentation as also the media release. And would have noticed that once again the ATL has posted splendid performance during Q3. And all around in terms of the operational part, which is availability factor, and then the fiscal performance in terms of EBITDA, the PAT, has really shown a remarkable increase in the Q3, as also the YTD numbers compared to the YTD 9 months of the previous year have shown good amount of jump. Besides that, the pipeline continues to be robust. We are sitting on a very good pipeline. We added 2 renewable projects during the quarter, plus we added the first project which will bring 400 kV grid systems into Mumbai. And besides these, you would have also seen the fact that the entire capital management program has been concluded. QIA has actually closed the transaction, and both from the point of view of their equity funding for 25.1%, as also from their participation in the debt funding, $282 million. Besides that, the quarter saw the mobilization of refinance funding by ATL as well as AEML. AEML, in fact, got concluded during the month of February, and of course, the 2 parts, $500 million by ATL was done during the previous quarter, and $310 million USPP funding got finished in the recent month. In fact, the circle up was done end of January. So our capital program has mobilized $2.6 billion worth of US dollar funding, and therefore both ATL as well as AEML today have long-term infra funding instead of corporate funding. So there's no love for the fact that we have dollar funding. The love is for the fact that we have infra funding, which means that these are long gestation, which also means that these are with amortization, which is much more friendlier compared to the corporate funding concepts that Indian bankers offer. And care has been taken that these are with fixed interest rates, and these are with long lock-in, and with the objective that whatever commitments we make in our business, we are completely backed up by the financing plans. So therefore, that's been a great achievement in terms of what we have been able to achieve over the last 2 quarters. Well, I'm going to stop here and look forward to your questions, and by virtue of that, perhaps we'll be able to respond on anything that I may have left out. So over to you. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Anyone who wish to ask a question at this time, they may please press star and 1. The first question is from the line of Varun Ahuja from JP Morgan. Please go ahead.
Good evening, gentlemen, and congratulations on the results as well as the recent closure of equity investment, etc. I have 3 quick questions, if I may. Firstly, I do see that on the electricity distribution asset, AEML, the distribution loss has been coming down quite well. You mentioned that the target would be around 6%. So if you could guide, is there a timeline by which you can get there? Is this target more like next 12 to 24 months and they can be further after that? Or is this somewhere you believe that would be, in line with where you think it may start normalizing and tapering off or settling down at these levels? That's the first question. Secondly, I believe there are hedges in place for the FX funding, but can you just guide what are the terms of those hedges? Is it throughout the life of the bond or is it for a certain period over the next 3-5 years, etc.? And lastly, this is more of a, you can say, business-wise generic question. My understanding is that there are some thoughts around the government looking to privatize more distribution or discoms in the bigger cities. If you could give some color on that, I presume that would be something you would be quite interested in. So if you could give some kind of color as to if you believe that that's something that would be in the pipeline in the near term, in the next 1 or 2 years, or still something which where visibility is low. Thank you. That'll be all from me.
Thanks, Varun. Thanks for your questions. Let me start by your first point was on the loss levels. Yes, the loss levels are coming down, and we certainly wish to get them to 6 or below 6. There are 2 components to this loss reduction. Number 1 is the technical losses, and the other one is, of course, the commercial losses. Right now, the effort was in terms of reduction of the commercial losses. Going forward, the effort will be on both counts. The technical losses will get addressed by virtue of some of the capex that we will incur, which has been now subsequent to our submissions with regulators, which has been approved, and therefore we will now get at that. And the commercial losses, of course, based on the studies that have been conducted, we have now granular information in terms of which feeders, which transformers have what kind of losses, and therefore what interventions will work in order to achieve what we are trying to pursue. And that is how the efforts have started. Your point was, what is the time frame in which we would want to reach up to 6%? The answer is that the budgetary part has 2 components. One, what regulator prescribes, and the other one which we internally pursue. The regulator prescribes close to about 0.25% reduction at the loss levels at which we are on an annualized basis, and internally we pursue close to about double of that. So therefore, if we are today at say 7.89, you can't expect us to go sub 7 in less than 18 months from now. I think that's the minimum period that will be needed to go sub of 7. And once we achieve sub of 7, then largely it will be not commercial losses, but largely it will be technical losses. And they will, Varun, take time as we commission the new cables, new transformers, we commission parallel networks which will reduce the technical losses. That would mean that the pace of loss reduction will not even be 0.5 a year. It could virtually be 0.35 to 0.4 a year. So that's the way that things will reduce. Your second point was on the hedging. And so from the hedging perspective, right now we are able to mop up based on the liquidity that exists 5 years cross-currency swaps. That's what we are able to mobilize, and we will have to continuously keep revolving them as and when that period ends. And that's the way the hedging is being covered. And of course, while the requirement is 95%, we are clearly pursuing for 100% hedging. The third part that you mentioned was with regard to the privatization. Yes, indeed, the government of the day is serious about the fact that there should be reforms, and perhaps privatization seems to be a good answer. Because I guess all the attempts that they have done, they've categorized that into two parts. Such are the discoms which have losses, or such are the areas which have losses above 18%, and the others which are below 18%. Those which are upwards of 18%, they want to target those first. From my perspective, I guess it should be seen more holistically, not just the losses, but the quality of software services, the holistic aspect related to how customer is getting what it deserves. But anyway, that's for some other time for us to dwell. Right now, yes, the government is pursuing an agenda for privatization, and we welcome that. And we are very much part of the thought leadership and advocacy on that subject. So we certainly will be very keen to pursue that agenda in the times ahead. Is there any follow-through question, Varun?
Just on hedging, you mentioned that, you're able to do 5-year swaps. Is that only on the coupons, or do you also hedge the entire principal amount?
No, we hedge principal amount fully, and then coupon, depending on that, we may hedge for 1 year or a couple of years.
Okay, so principal is for full 5 years, coupon is dependent, it can be a bit more flexible on that, right?
Yeah.
Okay, thank you. That's all from me.
Thank you, Varun.
Thank you. The next question is from the line of Prapti Gupta from BlackRock. Please go ahead.
Yes, thank you, and congratulations on the good set of numbers. I have two questions, sir. The net debt number which I see of 191 billion, so there has been a slight increase vis-a-vis FY19, which was, I think, approximately 170, 175 billion. So, I mean, what's driving that increase? And secondly, I read in the presentation on, the ATL looking at cost optimizations on USD bond issuances. So I just wanted to understand, I mean, what are we looking at and what can we expect over the coming quarters on that front?
So your first question was on?
The net debt increase?
We have certain greenfield projects also under execution. So as and when we draw in a quarter, the amount, then there is a slight increase in the debt. But you will appreciate that net debt to EBITDA is still in the range of 4.4. So we are very mindful and conscious about the same.
In fact, it's improved compared to the similar period last time, or the 31st March 2019 figures. If you look at net debt to EBITDA was about 4.7. Now we are slightly below 4.4.
Mm-hmm.
What was the next question? Second question was?
Second
question was on?
So I read in the presentation on you all are looking at cost optimizations to USD issuances. So
what we are trying to do over here is that we are creating the value creation model. So say we have these 7 projects which we completed. So originally, if you look at that, the original cost of that project was 36 billion rupees. We completed in 31 billion rupees. And then we have now financed it through the US private placement, whereby we will have an upsize of the debt which is available. And then the equity portion will be very minimal. So what we are saying is that with this model and the longer amortization of the period, back-ended amortization, we have a more surplus of cash available in the initial period. Typically, in the Indian scenario, you have to repay almost 60-70% in first 10 years. Here, this will happen only in the last 10 years. But earlier years, we will be saving on the cash flow, and that surplus which will be available is used for the equity investment, for the growth purposes. So that's a value accretive model which we are doing it. And because of this, upsize of the debt and still within the parameters, the return on the equity is going very high, which is going as high as to 50%. So that's what in our Energy Day presentation, which is on the website, you can see that how the the entire structure we have developed.
I understand. Thank you so much.
Thank you.
Thank you. A reminder to our participants, if you wish to ask a question, please press star and 1 on your phone. The next question is from the line of Mohit Kumar from IDFC Securities. Please go ahead.
Sir, one clarification, sir. This in the media we read that we have raised $1 billion. So I presume this 500 plus $10 million. This is the final figure for USD bond which you raised during the last couple of months. Am I right?
Yeah, that's all we know about.
Yes.
In fact, that part is that we get to realize a lot of things from such media news, which is at times very baffling in terms of the fact that right now we just got done with $500 million and $310 million of USPP plus $1 billion at AEML, and that completes our entire refinancing. So I completely sort of get surprised as to how somebody gets an idea that we would want to do $1 billion again.
See, with this refinancing, what we have done is that our liquidity risk for the short-term paper has completely reduced. Now we have, almost our 90+% of more than 5-year maturity, and then the remaining is only a short-term, which we are also, repaying. That CPs and all that we have repaid. So only working capital will be remaining over there as a short-term. But other than that, it's completely the change profile which we have done.
And so, related to this, where are all these bonds have been raised? Which entity and how much?
Sorry?
Which entity?
At which? Yeah, in the sense, is it in the both the papers have been raised at AEML level, or it's at some part at the other transmission companies?
So $1 billion is raised at the AEML level, which has no recourse to ATL. So it is ring-fenced at the AEML level only. Then ATL, we have a now total $1 billion bond. Original $500 million, and the another $500 million we did it in November to refinance the NCD local. And the $400 million which we have done USPP, which will be at the SPV level. So there is a cluster of SPV, 7 SPV which has become operational. At that level, there is a $400 million debt. But there is no recourse to the ATL. So it's all ring-fence structure which we are creating, like project finance structure, and link it to the PLCR, and which is very well accepted by the global investors.
Sir, what will be the capex requirement for the FY21 and FY22? And can you just give a breakup between distribution and transmission separately?
So as a thumb rule, you can consider that we have on a distribution side, we have around 1,500 crores as the capex requirement. And on the transmission side, we will be doing around 3,000 crore as the capex. So 30% of which will be funded from the internal accruals over a period of 2.5 years, because these projects are typically for 2.5 years. And currently we have almost 8,000 crores of worth of projects on hand.
Okay. I understand that out of 32 billion, 12 billion has been returned back to the promoter, and I assume that our promoter debt will be in the range of around 22 billion at the holdco. Is it right number?
At the ATL level, we have a total 3,800 crore debt, principal perpetual debt, from which we have reduced 12 billion, roughly 12, 13 billion, whatever is the amount we received. So that's the scenario. Outstanding amount will be in the range of around 26 billion, 25, 26 billion rupees.
The last question, sir. How is the bidding pipeline looking at this point of time? How much worth of tenders are opened where we are participating?
So there are huge opportunity which is coming up on RE, and we expect the good sizable amount of bidding worth around 10 to 12,000 crores coming up over a period of 6 months. So we have a good pipeline available. But as we have, in the past, we have a minimum hurdle rate of 16% while we're bidding. So we are not in for each and every bid to win. Basically, we are looking at the quality aspects as well.
And lastly, sir, there was one particular line, I think 6,000 HVDC line, which we are pursuing. Is there any progress or regulatory approval, or will it take time to finalize?
I think the DPR approval is going on with the regulator. We have got the LOI from the regulator. So I think it should happen in due course of time. It is okay.
Understood. Thank you, sir. Thank you.
Thank you. Any participants who wish to ask a question at this time, they may please press star and 1. The next question is from the line of Dhruv Muchal from HDFC Mutual Fund. Please go ahead.
Hi, sir. Thank you. I joined a bit late, so if I'm repeating, so sorry for that. So you have about 9 projects in transmission which are under construction. From the presentation, I see the total project cost is about 8,300 crores. If you can please also help, what would be the revenue from overall total revenue from these projects? If individually it is even helpful, or otherwise at least the total.
Close to about 1,000 crores.
1,000 crores overall from all the projects, from these 8 projects, including Kharghar Vikhroli.
Yeah.
Okay. Mm-hmm. So, sir, secondly, was on the 30-year paper that we have done. So the rate is around 5.2. So I've seen the 20-year paper and the other paper, the rates are lower there. So any reason that we have gone for this 30-year, probably that is the reason the rate is higher? Any specific reason going for this higher rate and higher maturity?
But the 30-year is almost like an equity instrument, boss. What is 5.2? Imagine when the amortization is such that you have to return bulk of this money in between 20 to 30 years. So imagine having equity money at 5.2%. So it's a classic infrastructure instrument, and it's very, very attractive. So in fact, if you say, if I have my way, I would say every possible bond should be 30 years. So of course, you won't get that kind of money every time with 30 years.
Normally, you pay around 60-70 bps higher to the regular this kind of a paper of 15 years, 16 years. So it is in that range, and this is the first in kind in the country. You can see that, you will appreciate that only Reliance in the past has done that. Apart from that,
was
also many years back and had a lot of an issue. This has now opened a door in the country for other infrastructure players as well as for us also. And just imagine that if we, as we have demonstrated in the past, the credit quality, if we continue to maintain the same, we have a huge door open for our upcoming projects which will become operational. So, they are very much, and these are the funds which are Cigna, Barings, MetLife, all of them. So, huge pile of money. So, I think this is a great achievement for the country as well as for the group.
Sure, sir. So you mentioned large part of the repayment is after 20 years. So if you can give a broad breakup, how much is 1 to 5, 5 to 10?
That we will share. We don't have an offhand on hand. We will share it with you separately.
Sure, sir. Sure. Because this gives a decent buffer to release equity upfront.
So it is.
It is. So that's what I'm saying. So in our Energy Day presentation, you just see there is a case study of USPP. You just see that how we have an equity return of 50% plus because of this.
Sure, sir. So in the presentation, you're also mentioning a rolling capex of 400 million. If you can explain, what does that mean?
So rolling capex of 400 million basically means is that there is a line of credit that has been established. And as and when you give a call, you have the capex approved, you are able to award, and you need the money, you call for that money. So it's been established for long tenure, and therefore you can keep drawing it at will. Of course, one has to give a bit of plan, but it's been like a line of credit.
So this is also the first time in the country this has happened, that along with the bond issuance, this is a stapled 400 million line also available for the greenfield capex. This has never happened in the past. So, now the AEML will focus on the capex portion and the, O&M activity only. They don't have to, have to worry for the financial closure for the capex program which they will be running. And we will be taking out every 3 years through the bond.
Okay. So if you can help us explain, how is it different than a normal financing which you do? I mean, just to get a sense of what changes.
No. So the alignment of the conditions of the bond. See, typical Indian funding happens with the FSCR, CSCR. Here the entire, the funding is aligned with the bond terms and conditions, which is linked to the PLCR, the graded DSCR, all of that stuff. So that gives a lot of flexibility in terms of, and what we have committed to them that this is a rolling facility. So every 3 years when we reach a milestone of 400 million, we will replace it through the bond, and that line will be freed up again.
Okay. Got it. And sir, lastly, for my accounting purpose, the QIA loan that we have got for about 2,000 crores. Now, is this also similar structure like the perpetual, and it will be the interest cost will be directly to the reserves, or it will be through the P&L? And if you can also share the interest rate if it is available.
So if you look our presentation, and the first of all under the waterfall mechanism, this comes after all senior secured and all the payments. So this will be, if there is a distribution surplus available, then the payment of interest to this on this subordinate loan will be done. Otherwise, it will be accumulated.
Okay. So it's almost similar to the existing the promoter debt which we had. The structure is almost exactly.
In our perpetual, what we have done was that it can be repaid only out of equity or equity type of instruments in ATM. While here, you can repay out of distributable surplus.
Okay. And the rate would be?
LIBOR plus, I think, 4% or something.
LIBOR plus 4. Okay. Got it, sir. And so last one, quick one. The project cost numbers that you have given in the presentation, these are not the estimated project costs by CRC. These are your project costs, right? Or the numbers would be significantly lower than this?
Yeah.
These are your project estimates?
Yeah.
Got it, sir. Thank you so much.
Thank you.
Thank you. Any participants who wish to ask a question at this time, they may please press star and 1. We have the follow-up question from the line of Mohit Kumar from IDFC Securities. Please go ahead.
We have one last question. We have some other meeting come up, so can you just quickly cover up?
Sure, sir. This is the last question.
Yes, sir. This is thanks for the opportunity once again, sir. One question, sir, in the terms of AT&C loss. We already at 7.89%, and I believe the benchmark for the Mumbai distribution are 8.3%. So, what kind of given that we have submitted our tariff proposal, what kind of, tariff, the benchmark we foresee for the next tariff period for Mumbai distribution?
No, you're saying what kind of loss level will the regulator use to build the tariff? Is that your question?
Your general comment on what kind of possibility is there to reduce the AT&C losses, given the 7.89% is quite low.
Mohit, I mentioned that at this juncture, when you reach these kind of levels, from 7.89 to any level below 7 will be maximum at the rate of 0.5 per year. And that's what we will target. That's the maximum that we will target. And, of course, the regulatory requirement would be anything like 0.25 or so. But we will obviously try and target double reduction of the losses. So you can now extrapolate. Once it goes below 7, then it will reduce anywhere in the range of 0.25 to 0.35 per year.
And secondly, also for the capex plan for the Mumbai distribution, we maintain our 80-90 billion rupee investment for the next 4 to 5 years, and this requires, regulatory approval. And I believe this is the last year for the tariff period, right? This year, FY20.
Yes, in fact, the MYT that has been submitted already includes this plan.
Okay, understood, sir. Thank you, sir. Thank you.
Thank you, Mohit.
Thank you. Ladies and gentlemen, that will be the last question for today. I now hand the conference over to Mr. Anil Sardana for closing comments. Thank you, and over to you, sir.
Thank you. Thank you to all the analyst friends. Appreciate your joining us for the Q3 FY20. And we look forward to your questions. Just in case you have any additional follow-through questions, do send it to Vijay or Jay, and we will be happy to respond to you. And, of course, you can also send it via Shirish. Thank you, Shirish, for your coordination, too.
Thank you, Shirish.